Welcome to the Elite Trainer Academy, brought to you by Mind Pump. In today's episode, I sit down with Doug Egge and we talk about taxes. This is a very practical episode, whether you're a new trainer who's trying to figure out the best way to structure your business or an experienced trainer who just wants to figure out how to optimize your tax return. I think you'll find this episode very valuable. And if you do, please share with a friend. Enjoy the show. So Doug, I think this is going to be a really valuable conversation for personal trainers. I wanted to ask you some questions around the back end stuff that trainers don't really, consider or think about when they're, venturing out on their own, starting their own business. And that would be like specifically like on the tax side of things.
Okay.
Where you have a bit of experience.
I do.
For those that don't know, what is your experience?
Okay. Well, so I am not a CPA, just so you know. Yep. I'm not an accountant. However, I have quite a bit of experience from the standpoint that I, first off, went to business school and I concentrated in accounting, never acted as an accountant though. And I've started numerous businesses over the years and am currently, of course, heavily involved with the financial aspect of Mind Pump. I'm the person that basically, works with the CPAs, the bookkeepers that work with Mind Pump. And so I do have quite a bit of experience and also an interest in tax, how to reduce taxes, how to structure businesses, and essentially how to build your business so that you get the best advantages.
Yeah, it's a lot of important stuff that people, I don't think, realize. Like when you're starting a trainer business, you're starting out as a trainer, like you don't consider that. You don't think like, oh, I should go learn about taxes and like how to structure my business. That's not really, the first thought that comes to mind. So often it's overlooked, but I think that there's a few simple things that trainers can learn that will take them pretty far.
Yes.
To be clear, this is not financial advice, but I did want to.
No, it is not.
But I did want to just get some insight into just some of the areas that trainers should look when it comes to, first, mitigating risk and liability. And then second, just trying to optimize, finances potentially. And like, potentially we'll get into some stuff around like maybe some ways to optimize for like tax deductions and things like that.
Right.
But just starting out like super simple for somebody that doesn't know, can you describe what an LLC is and why it's important?
Yeah. So an LLC is a structure. It's a business structure that can be used to run your business. It's a limited liability company. So as the name implies, there's limited liability. So if you have your business structured as an LLC, it can reduce your exposure and your risk because everything is now being run through that LLC. Of course, that doesn't mean you don't want to have insurance. You want to have insurance because you yourself can get sucked in. However, for example, if somebody were to sue you and you're operating out of your LLC, the LLC would be the thing that they would sue and your personal assets would be shielded. Now, this is in theory.
Right.
However, there are ways to get around that. So structuring is very important, making sure that you follow everything to the letter as far as your structuring of the LLC and your compliance. That's critical. Now, I'm going to mention that the LLC is a business structure that you have to pay for. You get it through the state. And if you're somebody, number one, if you're a W-2 wage earner, if you work for, say, Equinox as a trainer, you don't really need an LLC, right? Because you're getting all your taxes and everything covered by the company. The company itself may be an LLC.
Right.
And so your liability, your exposure is very low. And your taxes are also being handled by them. You really don't have a lot of control over your taxes. There's not a lot of opportunity to reduce your taxes, but it's extremely simple. Yeah. And so for trainers that are working for a company, a lot of this conversation today is probably not going to be super valuable to you. Right. However, if you're thinking about venturing out on your own, this is going to be super valuable to you.
Yeah. Well, yeah. So it's essentially, this is mostly applicable for somebody that's doing their own thing.
Yes.
They're running their own business.
Correct.
Generating their own income
Yes.
through personal training. I think this is really helpful though, because a lot of the trainers that I talk to that do work in big box gyms, most of them say, regardless of whether or not they will actually ever do it, most of them say they want to go do their own thing and build their own business. So definitely worth the listen if that's you and you're considering that. A question that I often get when I'm talking to trainers is how soon should I start an LLC? Like, is this something I need to worry about right away? Is it not that big a deal? And I have some time, before it becomes a big deal. How soon should a new trainer get an LLC?
Yeah, it really depends on where you're at. So if you're just getting started out, you really have no revenues. An LLC may not make a lot of sense because there's expense associated with it. You have your filing fees, you have your annual requirements. And so, for example, if you were to form an LLC in the state of California, it probably costs you maybe $350, $400 to get that formed. But the challenge is the state of California is going to ask for a minimum of $800 a year to service that LLC. So that is a pretty big expense. So you need to consider, where are you with your business right now? So if you're just getting started out, you're starting out as a personal trainer, you're really not sure how many clients you're going to have, I would say hold off on the LLC. Start as what's called a sole proprietorship. And that's super easy. That's that's through your personal tax returns. That's through your own social security number. And it's a very easy way for you to just say, hey, my business is this. It's Doug Eggie Fitness, and come pay me, right? Yeah. Now, what I would recommend in that case, if you are doing a sole proprietorship, is you can apply for a DBA, which is doing business as. You can do that through your county, I believe. And what that does is it allows you to create that type of business name, Doug Eggie Fitness, for example. And now you can take that down to the bank and create a bank account. So one of the big mistakes that people make in any type of business is they start their business and then they do things out of their personal bank accounts. Yeah. And what happens is what's called commingling of funds. So for example, you get revenue in for personal training clients, and then that goes into your personal account. And then you go spend that on, McDonald's, hopefully not, but let's just say you did. You go out to eat and you spend that money. Now what you've done is you've taken from your business pot to your personal pot. So you want to separate out those two things. So once you create your DBA and you go down to your bank, you create your bank account. Now what you want to make sure you do is you want to keep everything in that bucket that's related to your personal training account and your personal training business. And so any money that comes in, it goes into that bank account. Any expenses that are associated with your business come out of that bank account.
Yeah, I was just gonna say that, make that point. It probably makes it a lot easier to track things for like deductions and stuff like that too.
Oh, absolutely. And this is, again, the big mistake a lot of new business owners make is that they mix the two. They don't keep good records. They're just getting started. They don't really have a lot of experience with this. Yeah. And so by compartmentalizing this and being very careful about this early on, because if you grow your business, you want to even be more, compartmentalized about that. You definitely want to track everything, and you want to make sure that you don't get yourself in a predicament where, it's the end of the year, you filed your tax return, and something that you've done in your tax return is suspicious to the IRS. Then they come audit you. And now you have this massive mess where you've been taking money out of the business account, like your personal piggy bank, and you're not, properly accounting for your taxes. Now, next thing you know, you have taxes, you have penalties and that type of thing that you have to deal with. Plus, you don't want to go through an IRS audit. And I have some personal experience with that.
Oh, yeah?
Yeah. Like in 2005, I went through an audit, and it was because of a business I ran did not properly record it's actually some trades. It was some stock trades, and so what happened was it triggered the IRS. They came in And it took me a year to go through that audit.
Wow.
In the end, I only owed $1,000. So it wasn't so
it's
bad.
still a pain. It's still a
It
pain,
was
I'm sure.
absolute pain and stressful.
Yeah.
At that time, I had no experience with that part of the IRS, and I was scared.
Yeah.
I'll be honest. It was like very stressful.
Yeah.
Now I have more experience, so an audit wouldn't scare me so much.
Right. Can you explain a little bit more about the difference between sole proprietorship and LLC? Like, what are the differences there? Is it mostly like a liability thing? Like, what's the difference?
Yeah, so liability is part of it.
Okay.
So sole proprietorship, you are the business.
Okay.
So there is no protections offered by a sole proprietorship. An LLC is another structure. It's its own entity. And so it is essentially shielded from certain liability. And so if you're operating your business in there, you get some protections from that.
Sure.
I think the big thing will be, as you start making more money, it's going to be from a tax standpoint. So for example, sole proprietorship, you get taxed essentially on all your money. You can write things off. There's things that you can write off. But you don't have a lot of control over what happens to your like employment taxes. So when you let's just say you make $100,000 as a sole proprietor, you have something called your employment taxes. You got your Social Security and you got your Medicare, I believe it is. And if I'm correct, it's like 15.2%. So on $100,000, that's $15,200 that goes. That's just off that. That's not including federal taxes or state taxes. Okay, so $15,200. Bye. And you have no choice. Yeah. And as you go up, even make more money, that 15.2% continues up until like $170,000, and then it drops down. Okay. Now with an LLC, you have the ability to have it taxed as an S corporation.
Okay.
So an LLC is also going to face that same challenge unless you change the taxation of it. So there's a form that you can file with the IRS that allows your LLC to be taxed as an S corporation. And the S corporation allows you to take a reasonable salary, and then the remaining amount will come to you as distributions from the company. And so, for example, you're making $100,000, like we talked about before, and then rather than $15,200 in taxes, you can cut that in half. And the example would be you take $50,000 of it as salary, which would be subject to that 15.2% in employment taxes. Yet the other $50,000 would come to you as what they call a K-1 distribution.
Okay.
And that would be just taxed at your federal rate and your state rate. So that would save you half of that $15,000. That's $7,000 of tax savings by having the structure. And that's huge. Anywhere you can shave off tax, that's just money that's going out that the government takes that they didn't work for. You worked for it. You traded your life energy for that money. And any of that you can get back is a return of that life energy to you.
And that's a pretty simple thing, right? The S-Corp. I mean, that's just.
Yes. There's a single form. I don't recall, maybe 2553. I'm not sure. Okay. That you would submit, and they typically will approve it very quickly.
Okay. So what's the easiest way for somebody to start an LLC? I mean, I know there's a lot of companies.
There's so many out there. I mean, LegalZoom. There's many companies. You just search LLC formation, go online.
And they'll walk you through all of it.
They'll walk you through all of it.
Yeah.
Now, you can pay for different levels of service.
Right.
And, you don't necessarily need that higher level of service.
Now, if somebody does something like, say, LegalZoom, and they want to have their LLC taxed as an S-Corp, can they do that through LegalZoom, or is that a conversation with a CPA that they have? Or
I don't know if they offer that service. So I've formed companies through LegalZoom before, and I've always submitted the form myself. It's very simple. You just search irs.gov.
Got it.
Look for the S Corporation election form. And again, I don't recall the number. Right. And just fill that out, submit it, and they will send you a letter afterwards. and it will say that you have been accepted for S-Corporation election. And this is for taxation purposes. It's not officially an S-Corporation because you can have your entities taxed as C corporations, S corporations, partnerships. It's really an election.
Okay.
But you wanted to do it through an LLC.
Okay, got it. Interesting. What do you think are some questions that would be like really smart and beneficial for a trainer to ask their CPA? Like, what are some things that conversations they should be having with their CPA? Obviously, that would be one if they haven't done that already, is have the conversation of being taxed as an S-Corp. Are there any other obvious things that are like kind of just low-hanging fruit to optimize for some of these things? Like, whether it's deductions, minimizing liability, anything like that?
Yes. So that's one of the great advantages to having your own company is you have the ability to deduct many things, right? And there are all kinds of things as a trainer, for example, that you can deduct. I mean, you could potentially deduct your clothing, your shoes, as long as you're using it for your business.
Yeah.
Some people ask about cars. Well, can I deduct my car? You can deduct mileage, okay, if you're running your own business. So, for example, if you work for Equinox and you're going from your home to Equinox and that's where you work, you can't deduct that as mileage because you're not going to, say, a client. You're going to your job.
Right.
But if you work for yourself and say your home base is your home, then you can write off your mileage. You can track your mileage and write that off. I believe it's 70 cents per mile. But you do want to make sure that you keep good records of that. And there's apps and things that you can use as well that can help you, track that. And so by the end of the year, let's say you've driven 2,000 miles and it's 70 cents a mile. That's $1,400, if I'm not mistaken. $1,400 that you can write off of your taxes. So if you're at a 30% tax rate, that's like $420 or something like that. That's how much less you're paying for taxes. And again, our goal here is, number one, I have to say this, it's very important, follow the rule of law, okay? Don't go rogue on us here, all right? But it's your job to really go out there and see how little tax you can pay.
Yeah.
And there's nothing wrong with that. The tax code is designed that way. The tax code is telling you, okay, you can deduct this, this, and this, and this. Then go do it. So clothing, your home, let's say you have your personal training business in your home. Let's say you have a gym in your home. The space that you use for that business is potentially deductible. But it really needs to be for business use only. Yeah. So for example, if you have a little home office and you're using it only for your business, or a corner of your office, you can take the square footage, and I can't remember how much it is per square foot, you can write that off. Now, I'm going to talk about some audit risks.
Okay.
So a couple things that the IRS does look at is home office expenses or home expenses like that, and car expenses. Those are two big audit triggers.
Okay.
And the truth is, as a small business owner, you're at more audit risk than you are, say, than a bigger company. And the reason is it's low-hanging fruit for the IRS. Yeah. Small business owners make a lot of mistakes. They're very easy to audit. It's usually a shorter audit period, and they're going to go for that. And a bigger company's a lot more work, takes a lot more time, and bigger companies tend to be better run and organized, and so their chances of getting money is not as high. So as a small business owner, you definitely want to dot your I's, cross your T's, and do everything by the book. So those are some of the deductions. Other deductions, education. Any education regarding, improving your skills as a personal trainer. So certifications, books, whatever else, those could be all potentially deductible as well. Other costs of running your business, insurance, office supplies, if you're making flyers, whatever it could be. All of those things you should write off. So you should be very aggressive about looking at what you can write off and writing it all off if you can.
Mm-hmm. Now, what do you think is, obviously like hiring a CPA can be pretty expensive, especially like the good ones.
Yeah.
how far into a business do you feel like that's like a worthwhile investment as opposed to just doing your taxes yourself?
I'm a big fan of having professionals do things for me. So whether it's hiring a CPA or, I mean, even using like an H&R Block when you're first starting out might be a good idea. So here's the thing I'm always wanting to be mindful of is audits. People who do their own tax returns. I mean, the software out there is pretty good now, but all it does is take one thing that is not properly done to trigger the attention of the IRS. So yeah, you can do your own tax returns, but even if you do, I would suggest potentially having a professional review that. But now, if you're considering when you need to start doing that, if you're making $10,000 a year, probably not that important. But as you start to grow, and as you see that your business is starting to get bigger, and the potential is there, try to do it correctly.
Yeah, well, I mean, especially if you have long-term goals of continuing to grow and scale too, like it only makes sense to just set things right from the beginning. I remember one of the things that, kind of talking about the tax deductions, I remember one of the things that, I don't remember his name now, the Mind Pump CPA.
Oh yeah. Mark Sherman. Yeah.
Sherman, right? You had a conversation with him a while back in our trainer community. And I remember one of the things that he said that was like kind of like a duh moment for myself was just being very intentional about tracking receipts and notes and everything like that. I think that's probably one of the more overlooked parts of all of that is being like very intentional about the receipts you're tracking. And, I'd done a pretty good job with my own business of like having the receipts, but, he even said like writing down like a note on it, like, instead of just having your receipt from, a business dinner that you had and just keeping the receipt, but like actually writing on there, like business dinner with so-and-so or whatever it is.
And we discussed XYZ.
Right. So, and what he said was you want to be able to tell the story. Like that's how you're going to get the most out of your deductions and like prove that it actually is an appropriate deduction is if you're able to tell the story behind it. So I would say that's probably in my eyes, one of the bigger mistakes that new trainers are probably making with trying to, maximize deductions and all this stuff. Are there any other, or go ahead.
I was going to say almost all business owners, especially new business owners, don't do well with this.
Yeah. It's a lot.
Yeah, it's a lot. There's a lot. Unfortunately, business is not easy, right? They've made many barriers to having it be easy. It's not like, oh, I'm just going to start this business and, just put this money in the account and take the money out and live my life. No, there's a bunch of hoops you have to jump through. So being organized from the get-go is very wise. So every time you get a receipt, you get like maybe accordion folder, like January, February, March, April for the year. And then every time you get a receipt, just put it in there. Like you say, write the business purpose on it and put it in and keep those. You want to keep them for a number of years because they can audit several years back. So you just always want to make sure that you keep your records in place. Another thing you can do is get some type of accounting software. And every month you download all your transactions from your bank account into your software, and then you can kind of organize them into categories. So for example, education expenses could be for your certifications and things like that. And just keep those things accounted for every single month. Don't let these things get out of hand, because at the end of the year, now you're scrambling if you haven't done this stuff. It's like, where are my receipts? How much money did I make? What are my expenses? Whatever. That's a position you don't want to be in at the end of the year. So if you can start having good habits from the get-go, and there's very inexpensive and even free resources for tracking your expenses. Yeah. We use QuickBooks, but you don't have to use QuickBooks. There's other ones.
Even just using Google Sheets, like better than nothing. Right?
Yeah, better than
just
nothing.
Having just some sheets. Before we wrap up, is there anything that you think is important for a new trainer to understand about structuring their business? And, again, whether it's on the liability side of things or the tax side of things, is there anything that you feel like new trainers should know?
I think we've covered the basics pretty well today. Yeah. It's really, I think the thing that I would caution against is jumping into the LLC world too quickly.
Yeah.
I think I appreciate anybody that has a lot of optimism around their business and they have big goals. And if you have the money to form the LLC, et cetera, then maybe that makes sense for you. But for somebody that's just really just getting started out and has no real experience, maybe just stick with the sole proprietorship as you get started. And then as you see things happening, then you can take that next step. And as far as the liability aspect of it, of course, have your insurance. Mm-hmm. The LLC is just extra protection. And the LLC also, I don't think I mentioned this, is a way for you to build your business. So if you want to start hiring people, you definitely don't want to do that as a sole proprietor. Yeah. So if you really start seeing that your business is taking off and you want to expand it, it totally makes sense for you to get an entity, even in the state of California with that extra $800 a year that they charge.
Brutal.
But yeah, it's one of those things I say, take a look at where you're going, what your goals are, and where you see you're headed, and make your decisions based off of that.
Awesome.